Good afternoon, everyone. I'm Ali Simpkins, the local fund specialist at Momentum Investments, and I'd like to take this opportunity to welcome you to today's Masterclass session. Today, we welcome back Ian Scott, who's the head of our fixed income capability at Momentum Investments. Ian has more than 25 years of experience, and together with his team, manages over 80 billion rands worth of assets. During the session, Ian will be addressing key questions pertaining to fixed income, like what will the Fed do next? How will it impact South Africa? And what is the role of fixed income instruments within client portfolios within a low growth environment? If you can think of any other questions that you'd like to pose to Ian, please don't hesitate to pop it in the Q&A section, and we will be sure to address these questions at the end of the presentation. Without further ado, I'd like to hand over to Ian Scott.
Thank you, Ali. Hello, everybody. Cool. Let's just share screen. Cool. Here we go. Cool. Ali, can you see this presentation?
Yes, we're good to go.
Cool. Okay, let's kick off. Okay, so we'll just quickly talk around what's happening in the team. What are the assets that we manage on the different yield curves? We'll talk around what's happening in the globe. It's quite important. So what is happening with the Fed and the ECB? We'll talk around the SAGB and money market rates. And then we'll get into the duration asset classes. We'll talk around nominal bonds and inflation bonds. And yeah, if there's time, we can get into some of the funds, and I think we want to end up with the expectations. But at any point, if you feel free to ask me a question, and we can get into a bit of a debate around some of the issues. But let's kick off. So just from the team, so it's not just me managing the assets. There's 7 of us. So myself, Keegan, on the long end of the yield curve, so more into bonds and inflation bonds. Zizanda and even more on the money market and enhanced yield side. And then Karabo is our credit portfolio manager of our exciting new product in the private debt space. And then 2 credit analysts in Marley and Moleboeng. Okay, and what do we do? So we obviously manage fixed income assets, and we'll get into the different types of assets that we do manage. But remember, we are valuation based. It means that price is important or yield is important when we allocate 2 assets. We think that value is a long-term driver of alpha in fixed income markets. But remember, there's not just valuation. There's obviously various drivers in terms of diversification. How do we construct a portfolio? We have to beat inflation. Real rates is quite important to us. And then every asset that has to make it into our portfolio will go through some sort of risk adjustment, either through a duration or a spread or a rating or a yield. So we just don't chase yield. We say, well, what does it mean to suddenly have a 9% yield in 1-year NCDs versus an 11% yield in 10-year space? What does it actually mean? Where do we manage assets? Remember, assets, there's about 7 yield curves in South Africa. The one asset class that we don't, or yield curve that we don't manage assets on is the leverage space or hedge funds. So we are long only manager, but anything across the other 6 yield curves, and it's quite a complementary asset class to manage in. So we obviously do money markets. We think there's great yields at the moment in cash space. So cash is definitely not trash at the moment. We manage various forms of income funds, real income funds. Then the exciting one is our private debt fund, where we're really finding good opportunities in the credit market. And then we do manage 2 duration asset classes in terms of nominal bonds and inflation bonds. So if you had to look at our team, you'd say, well, what are we? Well, if you look at us, we are what we call a core fixed income asset manager. Cool. Okay, so what's happening in the globe? This is actually the interesting part. And as much as you've heard about it, it is about the Fed. And the Fed has created a lot of volatility in markets. It's not in probably the last, more than 10 years that we've seen that bonds are more volatile than equities. Yes, believe it or not, that especially when we found at the end of 2021 into 2022, these central banks are behind the inflation curve, if you want to call it, and now they're going to hike rates dramatically, especially talking around the Fed. mean, we saw bond volatility go up aggressively. That's the green line. So when that line is higher than the blue line is bond equity optionality. You can clearly see that when equities have lower volatility than bonds, you're in for a tough time, and that's exactly what happened in 2022. That, always we'll say, well, equities and bonds are not correlated. In 2022, that correlation went close to 1, and all asset classes had a very torrid time in that year. So what about the Fed? And people always say, well, why do we say it's about the Fed? It is important because the Fed sets the price of dollars, the cost of dollars. And you say, well, why is that important? Because we live in a rand economy. We have foreign borrowings. We trade in foreign currencies. We have to borrow or lend or buy those currencies in different markets to pay for our exports, pay for our imports, when the government is a fairly sizable borrower in dollars. So when the Fed changes the price of those dollars through hikes of interest rates, the cost of capital goes up. Now, why is the Fed sticky? There's two things. It's inflation on the way down. Remember, we had that quick shoot up in inflation towards the latter part of 2021 and into 2022. The central banks, especially the Fed, sat on its hands, didn't hike, and it got to 2022 and said, wow, we're now far behind inflation. Inflation has moved to 8-9%. We've got a target of 2%. Now we've got to move rates. And what we saw was the Fed moving rates to around 4.5% from 0.25% in 2022. What is the issue at the moment? Why does the Fed, being so aggressive on interest rates, keep on being hawkish? Well, firstly, inflation is sticky. We're only seeing inflation coming down now. I mean, earlier this last week, we saw US inflation print a 5 number, but that's still more than double the 2% target. So inflation is sticky on the way down. It's not just falling quickly again. The second part is the jobless claims, or the unemployment number. So unemployment is still very low, notwithstanding the fact that the Fed has hiked rates by 4.5%, right? Usually you would find if the Fed hikes by 4.5%, unemployment rises dramatically in the US. This time, not so much. So we're not seeing a huge spike in jobless claims or unemployment benefits. So the Fed says, well, if inflation is sticky on the way down, we don't have a bloodbath in the jobs market, we can keep on hiking, and that's exactly what they're doing. That's why it has such a big impact on the SARB as well, and on other central banks. So what is being priced in by the Fed? As I said, very aggressive in 2022 and the beginning of 2023. If you think that we stood at the end of the year and beginning, let's say January of this year, the market was saying, sure, the Fed continues on this path, we're going to end up with a Fed funds rate of around 6%. And then Nels bells in March, what happened? The first banking crisis hit. We know that banks in the US started to fail. A major bank in Switzerland failed, and these central banks had to put take their foot off the brake, saying, look, we can't hike as aggressive, so go tapering all those hikes back from 6% to around, the Fed is at around 4.75 at the moment. Now the market says, well, look, we think somewhere between 5 and 5.25, we think that's where the Fed will stop. The ECB will probably still keep on hiking because the inflation dynamics in Europe is very different. But the market is getting to a point where it says, well, look, the Fed has been very aggressive in 2022. Maybe it needs to taper off a little bit, and we'll get into the inversion of the yield curve because the bond market is also signaling huge red flags around this aggressive hiking cycle. I mean, we saw it in short rates in the US. If you think that the 2-year rate, the curve is inverted. Remember, short rates are much higher than longer rates in the US. At one stage, beginning in January, Feb, we probably saw that the 2-year rate in the US went all the way up to 5%. At the moment, it's probably just north of 4%. I mean, the 10-year rate went to 4.5, and it's at 3.5 at the moment. So you can see there was a very aggressive hiking cycle priced into this market, and this has now been tapered down. So talking about that yield curve, so you can see the yield curve is the green line at the top, and what the front end, what we call the left-hand side of the graph, is higher than the right-hand side, meaning the yield curve is inverted. Now, typically, a normalized yield curve would be more like the blue and the orange line, where short rates are lower than long rates, because that's what they call the term premium. Now you can see there's no term premium at the moment. The market is very worried about that front-end inflation and the Fed reacting on a negative way to that inflation. But what it means is when you get an inverted yield curve, there's also a risk of recession. And that's typically what's been happening now. And there's two things that drives it. One is the magnitude of the inversion. So you can clearly see that the difference between the 2-year yield and the 10-year yield at one stage was more than 1%. It's probably around 50 basis points, but it's still inverted. And also, secondly, the duration of the inversion, meaning that inverted yield curves don't last long because the central bank starts reacting. It's now more than 10 months. So the duration of the inversion is actually quite long. So that's two red flags. And maybe that's also a flag to the Fed saying, look, the market is telling you that you've been very aggressive. There's a risk of a recession or a slowdown. You've got to take your foot off the brake and not hike too far. Otherwise, there's going to be consequences and you might need to reverse policy. So what we are seeing is that when real yields rise, so when TIPS yields go up, it means there's tighter financial conditions, meaning, so what does tighter financial conditions mean? It means it's harder to get a loan, a car loan, a credit card loan, a home loan in the US, in dollars. And that's exactly what the Fed wants. But how far it should go, that's always the debate. But we can clearly see that monetary conditions are very tight. So we're starting to see the auto market being under pressure. We're starting to see the house market being under pressure. Think about it. 2-3 years ago, you could finance a 30-year mortgage in the US for probably 2 to 3%. Now we're talking about 6 to 7%. So it's basically doubled. The cost of financing a 30-year mortgage in the US is doubled. So there's a real cost for the consumer out there. And I think that's quite important to understand. And that's what the Fed will have to address, is this cost of capital. But you can clearly see that as much as they are hawkish on inflation through interest rates, they're still very willing to print money, because think about it, in this whole banking crisis that we saw playing out in the US in March, they were willing to expand the balance sheet. So yes, they're hawkish, they're hike rates, but they're willing to print money. If you think about it, the Fed balance sheet went from $8.2 trillion to $8.7 trillion. $500 billion was printed to put more confidence back into the interbank market. So it's clearly the Fed has got two policies here. And it will be interesting to see how it plays out. In terms of the market's expectation of inflation or forward inflation. So the market at one stage says there's no ways that, the Fed hasn't been hawkish enough. It won't get inflation back into close to the 2% target over the next 5 years. That's now been tapered quite a long way back. And you can see the market now saying, well, look, we think over the next 5 years, inflation will probably average around 2% in the US. So a big change in inflation or forward inflation expectations in the US market. And I think that's quite important. That's quite an important signal for the Fed that, look, guys, we've done a lot. We don't need to do a lot more, because remember, monetary policy is not about today. If you hike rates today, it will only affect monetary conditions probably 12 months out. So there's still a lot of tightening of financial conditions that will still have to come through in the US economy, because all these rate hikes over 2022 will still have to come into the financial conditions model. We look at spreads because it's important for emerging markets. So yes, spreads are moving higher. You'd not be surprised when there's some sort of call it smaller banking crisis in the US. Dollar spreads move out, European spreads move out. It is a canary in the coal mine. So we've obviously seen that in that whole, call it banking solvency crisis or liquidity crisis, our spreads have moved out in terms of credit default swaps, in terms of South African sovereign spreads. The rand took pain, our own bond yields took pain. So definitely we look for this when we're starting to see, well, we'll probably expect to see more defaults in the US economy, in the auto market and in the housing market. These spreads will widen, but this is also a market that suddenly is giving us opportunity in terms of investing in credit spreads and in high quality corporates at much more attractive spreads than we've seen over the last 5 or 10 years. If we jump over the pond in terms of euro, where's Europe? I think Europe, you can see also inverted yield curve, maybe of a lesser magnitude than in the US. Still important that market is obviously still worried about a recession in Europe, but obviously a lower concern, because I think they came through this winter working out the gas shortage and whatever they needed to do. So Europe probably in a better space in terms of growth. The bond market is not that deeply concerned with recession. Yes, it is inverted. But the ECB faces probably a bigger inflation problem than the US. If you think that in different territories or countries in Europe, you probably find that inflation is somewhere between, 8 to 10%. So there's definitely still 3 or 4 rate hikes, if not more, from the ECB on the way. Same for the Bank of England. I mean, UK inflation is more than 10%. So the BOE still have got a lot of work to do. So you can clearly see that in 2022, all the central banks lifted the tide and they were all hiking. Now we're getting to a point where some central banks are starting to get to the end of their rate hiking cycle. The ECB, the BOE, they still have to hike, but you probably find, as we said, the Fed, the SAGB, the Bank of Japan, the People's Bank of China, they're probably all getting to a point where they're probably more in a neutral space, if you want to call it. They're not hiking or cutting. They're probably in a holding pattern. What's happening to credit default spreads also risen. You won't be surprised. So what is a CDS spread? That's the cost for the South African government, SOEs, corporates to borrow in offshore markets. The graph that you see here is for the government. So where would the government borrow in dollars in over 5 years? It's probably around nearly 3%. That's just where we are. So you can clearly see when there's elevated risk in dollars and risk of liquidity in the banking system, these spreads have to go up. It's risk spreads, but it's nothing out of line with our peers. But what we did see over the last while is that the purple line is Brazil. Now, Brazil is actually rated a credit notch below us. So theoretically, our CDS spread should be lower than Brazil. What we've seen is through all our own South African idiosyncratic factors like load shedding and grey listing and these type of numbers, that our CDS spread actually widened versus Brazil. So it says to us that the market is saying, look, you guys have got internal problems as well. You've got to solve them. Otherwise, the market is going to charge you a much higher credit spread to borrow in dollars. In terms of bond yields, we've obviously seen a big move up, and now we've seen a big comeback in bond yields. As I said, at one stage, we saw that the US 10-year was probably around 4.5%. It's come back all the way to about 3.5, 3.6, 3.7. So a big comeback and a big change in sentiment where it says the Fed's not going to hike to 6 anymore. It's probably going to hike more to around 5 or 5.25. So less hikes expected. So those bond yields can ease. In terms of our own bond yields, I think we've obviously seen a big kick up in our own bond yields. If you think that we probably started the year in around 10%, went up all the way probably to close to 11%, and now we're trading probably around somewhere between, call it 10.70, 10.60, 10.50. We're actually in quite a holding pattern at the moment in terms of bonds. I think the bond market wants to try and find out where is that level where it should trade, given all the idiosyncratic factors in South Africa, and we'll get a little bit into more detail when we talk around the nominal bond market in South Africa. Right, so that's the offshore picture. So the offshore picture is starting to look a little bit better in terms of rate hikes and inflation that brings that risk-off environment into South Africa. But what does it actually mean for our South African fixed income asset classes? So if we jump to the money market, so the money market is obviously still worried about the SARB. I think the SARB obviously surprised us in March with that 50 basis point hike. But it wasn't just that, it was the aggressive nature or the hawkish nature of the governor coming out and saying, look, we may not be finished here. Although I think even where our inflation is moving, where our growth is, and look, the risk is out there that we could already be in a recession, is that I think, the SARB is going to be tied by that at one point in time where, yes, inflation is coming down a little bit slower because of sticky food inflation, because the guys are spending money on running their generators and they're adding it to food prices. But, you can do what you want. The guy's going to spend the diesel to keep the lights on. And there's not much that interest rates can do about that. So I think the SARB is also between a rock and a hard place. But I think they've done enough. So in my view, it's not to say they can't hike again. But if, at 7.75 on the repo, they've probably done enough. But let's see when we get to the May SARB meeting. But what it means is that cash rates have gone up quite dramatically in South Africa. So we think cash is one of the more interesting fixed income asset classes at the moment. So we keep on saying that, if inflation this year averages about 6%, we're buying 1 year NCDs around 9%. It's not often that you find that cash will give you CPI plus 3, especially in an environment where you're uncertain. Will the world go into a recession? Will central banks be more hawkish? That type of thing. If you're uncertain about equity valuations or that type of thing. look, sitting at inflation plus 3 for a short period of time is not the worst place in the world to be. We think that, you know, 1-year NCDs at more than 9% is a very attractive, and the market still keeps pricing. This is what we call the forward market, still expecting some sort of rate hiking cycle, pricing in for about another 25 basis point hike in the May meeting, and even another chance of a 25 basis point hike at the July meeting, which we think it's just totally over the top. But it means when these markets become too overpriced, it gives us the opportunity to lock in very attractive yields for our investors for the next year or more. Yes, we see that floating rate spreads, what we call the bank funding curve, is also moved up. So even if we go to a more floating rate environment, especially in credit space, we're seeing JIBAR ticking up. So that's actually very nice in terms of getting higher yields into our funds even on a floating rate basis. So we don't just lock in all the fixed rate notes. We think there's interesting opportunities in floating rate notes as well. So that's just what's happening in cash markets. Definitely one of the asset classes that we do like. Right, what's happening in investment grade? So the listed rated credit market, in a sense, it's an issuer's market at this point. So what do I mean? It means it's a great time for corporates actually to come and borrow money in South African debt capital markets, because spreads are very low. There's huge demand. As we always say, there's about 130, 140 billion of issuance into this market. So this is purely on the JSE. It's listed rated paper. It's typically your Barloworlds, your Bidvests, Toyotas, all these type of big names that we know come and issue debt instruments into the South African debt capital markets. They trade at very tight spreads. The balance sheet quality is very high, but the pricing is not attractive. So the issue that we have at this moment is there's about 130, 140 billion of issuance into this market, but there's probably about 1.5 trillion of funds looking for assets in this market. So you can clearly see that the demand just outstrips the supply by 10 to 1 and by a long margin. So you would not be surprised to see this is the pricing or the spread. Now, when the curve moves from top left to bottom right, it means spreads are falling or prices are rising. For us as a valuation-based team, this is quite a hard thing, because it says to us, sure, we're buying expensive assets, which we don't want to do, because it's a risky trade to buy expensive assets. But the quality of the balance sheets are very good. So we think that banks in South Africa are very high quality. It's a good place to hide if you're uncertain about the future, uncertain about markets. I think all the banks came out with the profit statements and results over the last month or so. Or, somebody like Standard Bank had the best results in their history. It just shows you how good the banks have it. All the banks came out with good numbers, high capital ratios, which is good for us. Maybe it's not always great for the equity guys, but from a bond perspective, there's a lot of safety in bank funding and in bank capital instruments at this point in time. As we said, for corporates as well, so typically the Barloworlds, the Bidvests, CUPs, Life Healthcare, all these type of names that we deal with on a daily basis, it's a good time for them. They come and issue into debt instruments into the DCM markets, probably at spreads below where they can actually get bank funding, and that's why they do it. It diversifies their funding base. So yes, a good time for corporates as well. For property companies, which have been very unloved over the last 3 years or more, there's good opportunities, because the balance sheets look a lot better than where it did 2-3 years ago. They took a lot of impairments onto the balance sheets. We're starting to see that there's good appetite for property companies as well. The sector that's obviously struggling is SOEs. They don't fund a lot because there's probably just no appetite for it. And if they had to fund, these charts would probably be on the right-hand side off the charts, in a sense, because the spreads would be a lot higher than where the market spreads are. We don't even have to talk around munis. It's probably impossible for them to fund at this point in time. So the part of the market that probably doesn't want a lot of capital because there's good profits is the private sector, but they do come in, but the spreads are tight. And then part of the market which wants to fund the SOEs, nobody's got appetite for that. The pricing is, I don't even think the pricing would be attractive at a multiple spread at this point in time. It's a sector that we want to avoid, and they can't issue at this point in time. So really a tale of two different markets in the credit space. What we are starting to see is green bonds. I think we all know about ESG, what's happening in that space. So yeah, it's a market that's growing exponentially. Last year, we probably had around 20 billion of issuance. This year, there's probably going to be a lot more of it. And probably going forward, there's going to be a lot more ESG, green bonds, sustainability-linked bonds, all these derivatives that we get into this market. Yeah, it's interesting. These bonds trade at a premium as well. So a lot more demand than supply. And it's always interesting to say, well, how much premium should we pay for sustainability, for ESG? A big debate at the moment. Should we pay a premium? Should we not pay a premium? How much is that premium? So, yeah, there's big debates around how do we support these ESG bonds. We want to, but not just at any price. Cool. So let's get into nominal bonds. Still our favorite asset class in fixed income. Why? Because we've seen a sell-off. Yields are much cheaper. We think a lot of negative South African news has been priced into the bond yield curve. Foreigners have exited the South African market into a meaningful way, and we'll get into the charts. So a lot of negative news sits in the price. So yes, it feels to be negative in South Africa. We read the news. We see all these things. We live through load shedding, and it is a real issue. But a lot of that already sits in the price or in the yield of South African bonds. And that's why we still think that this is a good asset class to be in. So remember, I showed you that the yield curves in the US and Europe were inverted. Now in South Africa, we've got what we call a normalized yield curve. So short rates are lower than long rates. So you get paid for having duration in your portfolio, but not duration at any price. So we say, well, maybe that 20-25-year point of the curve is not that attractive anymore. We think the more attractive part is the steepness part. So let's say somewhere between the 5-year point and the 15-year point looks a lot more attractive. And that's where typically our flexible income fund or our bond fund would play into all of these asset classes. And we still think that you get paid for it. I just looked at some of the numbers. I think that, duration gave you a very decent return over the last 3 years. And you can look for yourself, but I mean, something like your bond fund probably returned well over 12% over the last 3 years. It doesn't feel that way because 2022 was a horrible year. We basically got 4% from bonds, but over the last 3 years, very decent nominal and real returns from this class. And we think it's not over yet. There's still more juice into this market because yields are so elevated. And there's not a huge foreign overhang into our market. When the foreigners own, like in 2018, before Weekby, when foreigners own more than 40% of your bond market, you think, sure, something goes wrong here. You could have a major sell-off because foreigners are fickle. But, now we've seen the stats that foreigners have sold, and they keep on selling South African nominal bonds, but they're now down to about 25 or even less, 25% of the bond market. So really the guys who want to be out of South Africa are out of South Africa. But who's been the guys who's really been buying South African bonds? It is the banks to a lesser extent over the short term, but over the medium to longer term, so over the last 3 years or more, I'd say it's definitely the pension funds, asset managers, so and what we call other financial institutions classified by National Treasury. So asset managers, hedge funds, pension funds, we've been the big supporters. So it's interesting. So the offshore component has moved to the South African market, so it's much more domestic market now. Why? Because the yields are so attractive, it cannot be ignored. You probably hear from most asset managers that the valuation of South African bonds just cannot be ignored. Even if you look at the multi-assets, different types of multi-asset funds, you probably find that there's some sort of bond allocation even in the high equity funds, because at 11-12% yields, you just cannot ignore bonds when inflation is 5 or 6. 5 or 6% real yields in nominal bonds are very attractive at this point in time. In terms of returns, so when we stood here probably at the end of December last year, there were lots of reds. We've had a very good recovery in nominal bonds and inflation-linked bonds in this year. So you can clearly see that even over the last year or so, we've had very decent returns in that middle sectors of nominal bonds and inflation bonds for our clients. So yeah, it's looking a lot better than where it did 3 months ago. And that's why we always say that when you invest into duration, you have to have at least a 2 to 3 year investment horizon, because you do get this volatility in bond markets. Because if you exit it at the end of December saying bonds is a terrible asset class, which it was, you can clearly see you gave a lot of performance for exiting this asset class too early. And sometimes it's worthwhile just to stick it out a little bit, clip your coupon, as we say, because remember, at least you get your coupon, you get a return. It's not just a capital element. Yeah, and I think that investors are rewarded and will be rewarded for staying in this asset class for a period of time. Right, so let's quickly jump. So in terms of fair value, so yes, if we look at the markets, the fair value still says, well, long bonds in South Africa should be like 1140. Well, that doesn't make sense to us. You know, that it probably trades 10.5, 1070 at the moment. And we say, well, look, this is where the market says 1140 should be fair value. We think the market's expectation of inflation is just too high. We just think that, our risk premiums are too high. So for us, the market has got a very negative view on South African valuations. We say, well, look, we think probably fair value is somewhere between 10, 10 and a quarter. And if we move from 1070, where we're now in the 10-year bond, closer to 10, 10 and a quarter, there's very handsome double-digit returns for clients into bond space. If we move over the category, if you say, well, look, I'm worried about inflation also being sticky on the way down because food inflation could remain high, administered prices could remain high. So where do I go and hide? So one would be cash, obviously. The other one is going into inflation bonds. So typically you would say, well, in a high inflation environment, real yields should rally because it protects me. As inflation goes up, I'm going to get, I want that premium, right? Because you get that carry premium from getting high inflation. Last year didn't play out because of the correlation in bonds. So all the bonds in South Africa sold off. Once again, a 4% return. We've had a decent return now in ILBs coming back this year. So once again, if you exited at the end of 2022, you would have locked in or crystallized a loss by staying into these inflation bonds. I think there's a good protection strategy in it, and you've had some very decent returns in 2023 already from ILBs. The curve very flat, so this curve doesn't look exactly the same as the nominal curve. So the real value probably also sits here, probably let's say from around the 4 or 5 year point all the way to the 15-year point. And that's where our inflation bond position is mainly centered. You don't get paid for taking very long duration here in this market. It's just not attractive at that level, but there's value in that front and middle end of inflation bonds, especially if inflation in South Africa is going to stay sticky for a longer period of time. Talking around break-even, so break-even is the difference between the nominal bond and the real bond. So the 1070 and the 4.5, where the 10-year bond is trading, that gives you around that 6% on the I-2033. So I-23 means it's going to mature in 2033, the 10-year bond. So yeah, we still think that, meaning that how do break-evens close? Well, either real yields go up or nominal yields go down. We think that, well, real yields are probably fairly priced, but you get the inflation carry. That's why you get a good return. The break-evens will close from the top, meaning that we think there could still be a bit of a rally in nominal bonds, closing those break-evens, and that could be what leads to attractive returns in nominal bonds. Right, I don't want to jump through funds in the interest of time. I just want to quickly end off with our expectations. I can always send you the presentation. So what do we expect? So we always put the peg in the ground in terms of inflation is going to be 6% this year. So what can we expect from the different asset classes? So I said to you, look, we're buying 9% 1-year NCDs into our fund. Now, obviously, our fund can't yield 9% because we can't fill our fund with 9% yields because there's a duration, there's a regulatory limit on our money market fund. But for example, our money market fund at the moment is probably yielding around 880 or 875. So you can clearly see we're already at the upper end of what we expect cash will do over the next year. But once again, if inflation is 6 and you get around 8.5, inflation plus 2.5 from a money market fund, that's attractive returns if you really want to go and hide in a space because you're worried about the world, you're worried about recession, these type of things. You can go to the credit market, you'll get a very similar return in this 8.5 to 875. You'll take more credit risk, but you won't get a huge uplift versus cash. So cash looks attractive to us. Then the 2 duration asset classes, we always say you're going to be rewarded for taking duration risk. We've proven it that over the last 3 years, being in that steepness of the nominal curve and of the ILB curve, you get paid for that, but you've got to sit and wait. It's going to play out over the next 2 or 3 years. It's not just going to play out in 2023. But if we think about from now to 2025, I think that bond investors will be rewarded well. So if you're more worried about inflation and what could happen in South Africa, and you're worried about the rand, well, maybe you're going to sit in inflation bonds and say, well, look, I'm quite happy to take this 9 to 10% return, which we think is a conservative view. And if the rand blows out, I'm going to have even, and inflation goes up, I'm going to have a better return than that. If you say, well, it already sits in the price, the rand's undervalued, we think inflation will come down, which is our view, and the SARB will take the foot off the pedal. Will they cut rates? Well, that's the jury's still out on that one. But even if they don't cut, they just sit where they are. I think there's very attractive returns in the nominal bond curve. Returns from 12 to 14%, which doesn't seem likely at this point in time. But we've probably already had nearly 3.5% return from nominal bonds in this first quarter of 2023. We think that trend will continue, and that's why it's still our preferred asset class at this point in time. So what do we do in the different asset classes in our funds, just to position it? So we talked about cash. So we like this 1 to 5 year part of the cash curve, and selectively in those funds. Remember, those funds can't take a lot of duration. So we're buying selectively. We're finding opportunities between the 1 and 5 year point on the curve. We talked about credit. We still stay in floaters in our credit. So your enhanced yield fund typically is just more than 90% in floaters, not a lot of fixed, because the South African credit market has migrated to a JIBAR or floating rate market. As we said, we like nominal bonds. You get paid for duration. We like selective points on the ILB curve. We think there's good inflation carry elements into it. So if you like the inflation story, we think there's good returns in that market as well. We don't like fixed income derivatives at this point in time. We think they're very expensively priced. And in your portfolio, you can't just make a binary bet into one fixed income asset class. I think it's quite important to understand that you've got to have different components. So when you look at your total portfolio, your client's portfolio, you say, well, look, I've got a certain allocation to fixed income outside of equities and properties and global. So how do I allocate? And you say, well, look, I've probably got to allocate something to cash because this 3% real yields are attractive. I've got to allocate something to the credit space, which will probably give me a similar return to cash. And then you say, well, look, then I've got to make a decision on inflation or not inflation. If I'm worried about inflation, I'll take nominal bonds. If I'm more positive on inflation falling and the SARB taking the foot off the pedal, well, then nominal bonds looks very attractive in that. But somewhere you've got to have something of everything. You can't just take a binary bet on either cash or nominal bonds. You've got to have a combination of those different yield curves in your overall portfolio or your client's portfolio. Right. So how do we end off? Yeah, it's tough because we all live in that load shedding world, as I said. But look, there's a few things on dial. The budget in Feb was not the worst thing that we said. In fact, the minister probably had a very decent budget given the cards that he had to deal with. Giving Eskom the 254 billion, which is a big number, is a solution to their financial problem. Now, Eskom's problems is engineering related. I think we're sorting out the financials, but they've got to sort out the engineering part of it. Inflation is going to come down. Yes, it might be slow, but at some point you might find that inflation we might get to June, the June number, which is published in July, something like 4.6, 4.7 on inflation, and that's going to change the mindset of the SARB. So we think inflation will recede dramatically in the middle part of the year. So that could be interesting for the bond market as well, when bond yields are 10.5 and inflation is 4.5. And a SARB that turns less hawkish because they're very hawkish at the moment and feels like they're only looking at one side of the equation, which is inflation. They really have to look at the other side of the equation, which is growth. I mean, there's no points in keep on hiking interest rates and you're just killing a job market, you're killing businesses, you're killing the consumer. There's no point to it. I think the risk for us is that the Fed probably continues too far and then they have to play catch up. So suddenly you get a Fed that wants to go to 6%, then the SARB will probably have to keep on hiking. So that's obviously a big risk. We hope they can be more independent, but it doesn't feel that way. And global recession, obviously very high on the agenda. There's big risks for that. Even the Fed came out with a statement late last week saying, look, the risk of recession in the US is rising. That may not be global recession because maybe Europe, China, these type of economies are in a much better space than what people give them credit to. So US recession seems to be more probable, global recession less likely in my mind. We talked around grey listing. I think, it's been in the price. We've seen it in the CDS, but how does it affect South Africa? I think only the medium term will tell. And then we don't have to talk around the issue of load shedding. It is a problem, and it's going to be hard to see the rand sustainably below 18 while we've got perpetual stage 6 load shedding. The guys have to get the engineering skills together and try and solve the Eskom issue. Cool. I think that is my 40 minutes up. I'm quite happy to take questions.
Fantastic. Thank you so much, Ian. We really appreciate that. We have actually quite a few questions, if I'm honest. So we have questions coming through on the chat, and then we also have questions that come through during the registration process. So I think you've touched extensively on the reversal of interest rates. You showed us the FRA curve. You said almost the jury's kind of still out with the South African Reserve Bank and what they'll do and how they will respond. But maybe if you could be really explicit in terms of what is your expectations and when do you think this will occur?
Oh, can't we have the R1 million question? No, I'm just kidding. Ali, my view is that they've done enough. They don't need to hike further. But as we've seen, central banks can surprise you because in their deliberations, they get hawkish or they get less hawkish or they get dovish and you don't know. So we can only forecast, right? Or we can make an assumption. Our assumption at this, that the team assumes that 775 is the top of the cycle. Can they hike to 8%? By all means, they can hike in May for having FOMO. You could stand up and say, look, inflation is still 7% and blah, and we're going to keep on hiking. But there's always a difference between what you think the sharps should do and what they are doing. But at the moment, as we say, we think that as a team, we think this is the top of the rate cycle. Could be close to the end of the rate hiking cycle. But I think what's more important is that we're locking in high real yields for our clients now, and it will play out in the funds over the next year or so because, getting inflation plus 3 type assets into our cash portfolios and into the cash portion of our portfolios, I think that's a great opportunity not to be missed in South Africa.
Perfect. Thank you, Ian. I think before we unpack the funds and how we actually execute on some of these opportunities within the unit trust space, I want to add one more question around the macroeconomic view. It's from Charles. It says, why has gold been running up with rising tips?
Yeah, who knows what's happening in the gold market, because it's interesting that it seems like central banks are major buyers of gold. So I'm not always sure that the gold market is a inflation hedge market, if you want to call it per se, like the ILB market. I think there's a demand and supply story in gold. And we know that interesting is that, remember, the PBOC, the Central Bank of China, always recycled their reserves or their trade currencies into dollars and US treasuries. And now with this friction and conflict now between China and the US, they're not buying treasuries anymore, they're buying gold. So I think there's a demand and supply story in the gold market, which has got very little to do with valuation. It's got to do with China doesn't want to buy US treasuries anymore. It's recycling into gold. And there's other central banks as well. So a similar situation is happening probably in Saudi as well, where Saudi always used to take the petrodollars and recycle it back into the US in treasuries and US assets. I think that a lot of those petrodollars are also now going into gold. So there's a demand and supply issue it's not an issue, it's a demand and supply story that's suddenly unraveling in the gold market. It's not purely a valuation story. Why is tips rising? Also, it's just that's more a valuation story. So tips have to reflect the tighter conditions, the higher real yields in the US. So as the Fed hikes rates and real yields go up, I think the tips market has to reflect that reality, that there's higher real yields available in that market. So that's purely a valuation story on the back of a Fed rate hiking cycle. But gold is a demand and supply story.
Okay, fantastic. Speaking of a demand and supply story, our next question relates to credit. Ian, I think firstly, we could maybe just establish the difference between the credit market and the private debt market. That's the first one. And then just address Charles's question around why did AT1 yields, or for those of you who don't know, the alternative tier 1 capital yields in South Africa, not pick up post the write down in Credit Suisse? And how much exposure do we have to AT1 notes in some of our funds? And then just expanding on this, is there any other loss absorbing assets that are in some of our funds in terms of the capital structure?
Yeah. So I mean, to Charles's question, it's a long question, but anyway, let's get into it. The credit market. So I mean, what we call the DCM market is the listed rated market, and that's typically your top 50 corporates in South Africa, typically Anglos, a Sasol, Billiton, whatever, South 32, whatever we want to call them, which have got a global scale or a national scale rating, and they issue debt into the South African market in an auction basis. They come to a bank and they just issue the paper, right? Your private debt market is literally smaller type corporates. They may not be listed or rated. They come on a private deal basis to the likes of ourselves, like Momentum. They say, look, Momentum, we've got this business. We need funding for a capital project or a corporate action or whatever. We want to do a private deal, and it becomes a quasi-legal process, right? And we get into loans, or we get into debt instruments, and there's legal guys involved, and there's debt structuring guys involved. So you can see it's a much more complex process, but we're finding much more interesting deals in the private debt market than in that DCM market, which the demand and supply just is totally out of kilter at this point in time. Okay, now you're talking about AT1. So Basel III was really not tested yet until we saw what happened. And I'm not too worried about SVB and First Bank in the US, because remember, they're not Basel III compliant. What you're really referring to is the AT1 being written down in Credit Suisse and the equity guys actually staying alive. And that's what I've been saying for a very long time, that there is a fundamental flaw in the way that the BIS, the Bank for International Settlements, wrote the Basel III legislation. Because if you think about it, they've taken AT1 was always supposed to be more senior than equity, but the equity guys actually are still alive in Credit Suisse, and the AT1 guys have been totally taken out. So it says, well, AT1 is now more risky than equity, but the fundamental flaw was always in the legislation, where you can work out that central bankers want to keep the equity guys in the capital structure. Now, we're talking very technical stuff here, but you can work out that central banks will want to say, look, you know, when we have to bail out a bank because of solvency issues or liquidity issues, we want the equity guys to take pain, and they have taken pain, but we also want them to come back and follow their rights in a right issue, put more capital in, and have a seat on the board, and then they fire the oaks who created all the nonsense. The debt holders just get taken out. So there's a fundamental flaw in the way that Basel III legislation is written, and it will happen across the world more and more, that AT1 is more risky than equity. And you can see it in South Africa as well. I mean, through the ridiculous pricing that we're seeing, yes, South African banks are safe, and we don't think they're going to default. There's a low probability of default. But why would I buy AT1 debt in South Africa, JIBAR plus 300, when equity risk premium in banks are sitting at 6 or 7%, or rather under equity? And I know I can be taken out in totally one. My total capital can be written off in AT1, but I'll still, if I own the equity, I've got a higher risk premium that I get from the equity, more liquidity, and look, if I have to follow my rights, I will follow my rights in bank equity. I won't own AT1. Saying that, in our private debt fund, there is AT1 through various reasons. There's a little bit of AT1, but it's a very small percentage, probably not even 0.5% of the fund. We are not buyers, we inherited it in the fund. So we're going to wait until it matures, and then we won't roll it. So, but we are not natural buyers of AT1, because the pricing doesn't make sense to it. Because to me, AT1 debt should trade at exactly the same level as equity risk premium. So JIBAR plus 6 to 700, where the equity risk premium sit. Saying that. Secondly, we do own capital instruments. Now, where we feel that there's more value in the capital instruments is actually in the tier 2 capital. So typically we get JIBAR plus 250, 280 on that type of number, but it sits at a level above 81. So theoretically, in a bank insolvency or bank bailout, a big portion of the equity would be written off, the prefs would be written off, then 81 written off, and then you would only start burning into the tier 2. So yes, there is a risk of a write-off. We definitely own more tier 2, but in South African banks, not in global banks. But look, we're saying that if you think that in Basel III legislation, the SARB requires South African banks to hold about 8.5% of capital. They carry on average about 15 to 16% capital, so double the requirement. So they can burn through a massive amount of capital through NPLs and provisioning before we'll actually burn into the tier 2. But yes, 81 will take the first hit in South Africa because we're Basel III compliant. So if a ABSA or a Nedbank had to fail tomorrow, the 81 will get burned first, and the equity guys will actually be better off, believe it or not. So that's why we don't own it. As we said, we didn't buy it. We inherited it in the private debt fund, and we're going to let it mature because that market is also very illiquid. So that's where we are. So we like bank capital instruments, but only to the tier 2 level.
Awesome. Thank you, Ian. So for those of you who are interested to understand how to practically take advantage of some of these opportunities within the capital structure and within these sorts of capital instruments, it's actually executed through a fund called the Momentum Income Plus Fund. So if you want any more information around our private debt fund, please don't hesitate to contact myself or your investment consultant, who will definitely provide you with more information on that fund. I think, Ian, it's a good opportunity. We only have a few minutes left, but it's a good opportunity to just start to touch on our other fund, the Momentum Income Plus, the Momentum Flexible Income Fund. That is the fund that is the best investment view of you and your team in terms of the fixed income landscape. So maybe we can just then answer the last question, which is around which fund would you use this environment?
Okay, so on the fund I would use, so I don't want to talk my personal investments, but it would be the bond fund, because I understand where bonds are, how it works, and as a differentiator to equity in portfolios. Look, it's an asset class that we like the most, and I think there's a lot of value in nominal bonds. So for me, I like the bond fund, but it's because I can allocate between the different curves, and I'm just talking about myself. If you sit a level away from the market, it becomes a lot more difficult, because I mean the question always is on which yield curve should I be? That's question one. Credit, nominal bonds, ILBs, cash. And the second question that you always want to ask, okay, so once you've decided you're on the nominal bond curve, where should it be? Is it the 3-year point, the 10-year point, or the 30-year point? Now we answer that question in the flexible income fund, because you get the team's best view, not just on which asset class you should be on, but where is the best points on that yield curve. And that's where the flexible income fund actually outperforms the bond fund in a sense that on a risk-adjusted basis, it actually has a better return. But be it as it may, you get the best view of the team on every point of every yield curve. And that's basically so you get the best view from the cash curve. So you get 1-year NCDs, you get the best credit views in there, you get the best nominal bond view, the best ILB view, and the best offshore credit view in there. And we've now actually allocated a bit of property in flexible income fund as well. We think there's good returns to be had from property equity over the next 3 years or more. So, if you can't asset allocate between curves and on points on curve, the flexible income fund is really your, call it the fund that gives you that best of breed, if you want to use that allocation in the fixed income team.
Fantastic. Thanks, Ian. I think it's also just appropriate to now mention that the Momentum Flexible Income Fund does attract a platform discount through Momentum Wealth, and it's recently had an asset management fee reduction as well. So again, for any more information on that best of view fund, the Momentum Flexible Income Fund, you can contact us for more. And then we also can provide information on our private debt fund, the Momentum Income Plus Fund, as well as Ian's personal favorite, the Momentum Bond Fund. With that summary, I would just like to thank you all for your time. Any other questions, please direct it to us. And of course, thank you, Ian, for your time. We really do appreciate it. I just want to check there's no other questions. So thank you, everyone. Really appreciate it. Have a lovely afternoon. Until next time. Goodbye.
Thanks, Ali. Bye.